Good afternoon, everyone. Welcome back. I hope you all had a nice lunch. And we're going to do our best to wake you back up with a lively discussion about energy markets and the road to sustainability during crisis. So there's a lot to unpick in that. Let me welcome to the stage my panelists. First of all, Stefan Riediger, Director in Business Development for Power and Global Commodity Markets at EEX. Nice round of applause for Stefan there. And Gijs Stronk from ABN AMRO Clearing Bank. Apologies for the pronunciation. And last but not least, Piotr, who assures me I can call him Peter Listvon, Vice President from the Polish Power Exchange. So welcome panelists, and thank you for making the time. I think it's a nice novelty actually from last year. I think the energy markets are probably not as much in the crosshairs, so people have other things to worry about, so we can have a more mature and considered discussion. But I think it's fair to say that last year, with all the geopolitical upheavals, the kind of real-world effects on the person on the street, the energy markets were kind of very much an area of focus. So it's probably worth kind of looking back, and from a market structure perspective, Stefan, maybe you can start us off from your position, a kind of review of what happened, what the main drivers were, and kind of what we learned from that experience.
Yeah, happy to. I mean, last year, you said it, I mean, everyone has really felt it. I mean, everyone on his private utility bills. Last year was extraordinary. And last year's energy crisis, the 2022 energy crisis, actually started already somewhere around mid-2021. When people in the market realized that, gas storages are not filled up as they used to be in the past, and gas supplies from Russia have been limited. And so already around September, October 2021, we've seen first signals on the market of stress. But that was actually nothing compared to what we've seen last year. I mean, we've seen unprecedented volatility, unprecedented price levels across the energy complex, be it power, be it gas, be it coal as well. And we can say that although we've seen these kind of stressed conditions in the markets, I mean, markets have worked as they should do. And let me just give you maybe some data points to give you a feeling on the impact of that situation. I mean, when we look at power, right, and the most liquid market here in Europe is the German power market. For the decade 2010 to 2020, the average price for power for delivery in Germany on a wholesale level was roughly 40 euro per megawatt hour. And last year, end of August, we've seen price levels on the EEX markets that were close to 1,000 euro per megawatt hour. Same holds true for TTF gas. For the decade 2010 to 2020, gas prices hovered around 20 euro per megawatt hour. Last year, we've seen 350, 360 euro per megawatt hour. That was a spike over summer. And that had caused all sorts of stress when we talk about margins in just a minute. But since then, I think as a European industry and also everyone on a private sector, I mean, we've done particularly well coping with that situation. Because if you look at where prices are now, we are on levels that are 85, 90% down compared to last year's peaks. Yeah, so power prices around 150, gas prices around 50. That is still elevated levels, but nothing compared to what we've seen. So I would say last year has been extraordinary, but markets have worked as designed. For us as an exchange, it's important to always ensure that markets are fair and orderly. And for that, we've consulted tremendously and very closely, and sometimes a couple of times over the day, with our market participants, with the regulators, to ensure that there is fair and orderly conditions. And I'm proud to say that we've managed to safeguard markets through that storm. There have been no defaults on exchange level, on cleared markets. We have seen, and someone may have known already from their retail prices as well, I mean, there have been defaults in the OTC markets. Yeah? So retailers that have been unhedged did not survive that storm in that sense and went bankrupt.
So yeah, in general, OTC markets not doing very well at this conference throughout the panels across asset classes. But that's a very good prompt. On the pricing side, I'm going to prepare the audience. We will ask you to vote, so prepare yourselves on the app. We have a poll question coming up. But let's drill down on that sort of clearing and margin dynamic, and maybe Gijs, from your position as a clearing bank, perhaps you can tell us.
Yes, so looking back at 2022 for us and our experiences, obviously it's margin stress. We experienced extreme margins requirements. All our clients dealt with it very well. We had no defaults, no one was late in paying their margin calls, so luckily we have a good client base. But to give you an idea on where we were, on average on margin, what we were posting for our clients at the exchange, I think in 2021 it was about 3 billion. It went over in excess of 20 billion during the spike. So that's a little bit the stress which was in the system. Obviously, what you've also seen is that some of the utility companies are too big to fail because they're instrumental for the infrastructure for a country. That's also, I mean, having 100 billion of liquidity made available by the German government to support that. It felt a little bit like, and I've been part of that, the banking crisis in 2008, but now it happened in energy. So that's something which on the margin side really was stressful. What we've also experienced, a lot of our clients went OTC. So instead of being on the exchange, they brought things OTC, effectively swapping their liquidity risk for a counterparty risk, which is obviously for them understandable because they run out of liquidity and they want to mitigate the liquidity risk. But for the system as a whole, there is counterparty risk in the system, which is less visible than if it's on exchange. So that's one trend I've seen in 2022. The other ones is on the clearing side. So our fellow clearers, obviously with these high margins, our default fund contribution went up, but also clearers, which are fellow clearers, which have less strong balance sheets, also need to post additional collateral. So there was also stress on the clearing environment on how to cope with this. So how much of default fund contribution as a clearer do you want to put at risk in such a market? There's also limits to that. So that's something which is also a takeaway. And number 4, what is important is the price cap. The fact that the European Commission or Council put in the price cap on the market and intervened, that was also unseen. And we as a clearer were not very much in favor of imposing that. But I think, Piotr, you will probably touch upon that. So for me, the key takeaways also for 2023 is it's a physical market. I mean, it's supply, demand, if 30 to 40% of supply falls away, you either have to get more supply, which is LNG, or you will have to lower your demand, which is what happened with people shutting off their factories and consumers consuming less gas. That's ultimately the basis of what happened there. And if you look at 2023, what I see for my clients, which are in the physical market, they hedge much shorter on the curve, do much more spot trading, I think year out, and further out they tend to avoid more of that because of liquidity risk, and moving more and more to OTC in managing that risk. So that is a dilemma which I think is now in the system, that the counterparty risk has increased.
So a lot of moving parts to unpack there, but you've prompted us. So for
Yes.
those of you who weren't aware, and I'll forgive you, but I'll be kind of mystified. We now have a Dutch title transfer facility, TTF, price cap brought in by European authorities. Everyone's made their views on that clear on different sides, but it's here. So we're going to pull up a poll question now and ask you to vote and help us sort of understand what you think the effect of that would be. So typical journalist, I haven't given you a clear yes, no. We've discussed some of those issues. So you've got a flow to over the counter, whether you think it will remain on exchange with flow to other venues or alternatives, and we'll discuss that with Stefan in a minute. Or more reliance on non-European benchmarks, so or if you're unsure. So the key point here was that TTF is very closely related to the underlying electricity price, right? And that's the relationship they're trying to unpack. They call it a TTF price cap, but it's actually a price cap with a spread element embedded, related to the global LNG benchmark that we're in the process of developing, but we do have some data out on that. So lots there. And before we go into venues and alternatives, Piotr,
Yeah.
Can you give us kind of a Polish perspective on this idea of price caps and what you saw in the last year as well, just to round off the panel?
Okay, thanks. First, I'm not enthusiastic for giving price caps on the markets. But what I want to tell you are price caps on the Polish markets that were implemented last year, and we have still them on the market, not only on the exchange but also on the OTC and other trading platforms. But starting from the discussion, despite the whole European market is basing on the financial instruments, what you need to know, Polish market is basing on the forwards contracts with physical delivery. It's totally different. Of course, you are hedging the price for a longer time, mainly for yearly products. However, you cannot close your position just like that. When you open position, you have the VAT things, invoices, so even you close your position, you still have this position in portfolio to generate invoices day by day. So it's not so easy to close it, and it's with physical delivery included in that. So this is what our customers like, but it has also caused problems on the market. Especially at that time that we have. First, you just talk about the prices and the margins. I can tell from my side that we had the peaks on the around 500 euros. That was the maximum price on the energy price on the market. Mainly, so it's much lower than you had in Germany. But I think that the reason of that was the one political, the second the coal. We have lots of coal generation in Poland. And less gas, and we know that the gas was the price was disastering last year. So this is one thing, and the margin calls that we had, the maximum level was around 40 milliards euros. Our clearinghouse just called our customers. Of course, not everything in cash. We had like 80% of that was in non-cash, so bank guarantees, CO2 emissions, and green certificates. So just from the that was the first information. And what happened in Poland last year? Government introduced three big, heavy guns on the market. That was three regulations. One regulation was for balancing market. So they put the price caps for the energy producers that they could offer on the balancing market the prices only covering the costs of production with small margin on that. The first regulation had a significant impact on the spot market and forward market, so we didn't have spikes so much of the prices after that. And we hoped, as an exchange and clearinghouse, we hoped, and the market, we hoped that would be just this, but wasn't. The second regulation they implemented was cancellation of obligation to trade on the exchange. So that was the thing that it moved a little bit the trades from the exchange to OTC, and also lower the liquidity on the market. So that's bad. But we were just thinking what they are doing, and the reason of that was the merit order mechanism. They were just afraid that merit order mechanism, I don't know if everybody knows what's that. When merit order in the calculation of the price takes also the most cost generation, energy generation. So in that case was the gas. Okay. So when you want to close the demand of the market, you take also the generation, the most expensive generation, and it caused that the indexes are higher than it's supposed to be. So they canceled the trading on the exchange for electricity and lower for the gas. And the last one, which is more harmful for the traders, was the price caps for electricity and gas prices on the exchange, OTC deals, and other platforms. So they said, okay, the price for the energy is maximum. Let's say it will be 800 Polish money, so it will be around, let's say 200 euros, circa about, maybe less. So everybody who had open position above the price, with the price above that, they had to pay the difference between the price and the price in the legislation to the special fund. So what market participants did, they just stopped trading on the exchange. They didn't know what to do because most of them they couldn't make any profits on the market, on only other trades on the OTC. So that has very harmful impact on the exchange. So we had the shift from the trades from the forward contracts to spot. Now we have spot bigger than forwards every day because nobody knows what will be a next step. The third regulation is time limited till the end of this year, but nobody knows if it will be extended for the next year. And I hope that will not. So there is a big guns on the market, Polish market, and everybody hopes that will finish with the end of this year, and normally the market will go further. But this is the thing that may happen if TTF would be impacted by the price caps.
Key lessons there. So from a very kind of simple, straightforward, physical delivery market, allowing OTC, all these other things, quite severe price controls, and you can see there's been an effect of that. That's probably a very good prompt for us to pull up the poll results, because I quite like them. I didn't want to sway the voting, so now once we've got that up, you can see good solid 44% remains as is and goes to the alternatives, and that's what I wanted Stefan to jump in and discuss with us, because I think probably a lot of people in the room aren't aware what that means, right? So you guys have an organized trading facility that the price cap doesn't apply to. There are what you might call mirror contracts, right? And maybe some further launches in May. That's one of them, and some people have set up alternative venues in other jurisdictions. But I think the key point to some of the issues that Peter was referring to is, and you can correct me if I'm wrong and explain this, you're going to be allowed to do sort of margin offsetting between your exposures. So I think for those of you that listened to Klaus Lober from ESMA yesterday, he said, well, we expect little impact until prices look like they're going to hit the cap levels, and then you'll see a flow to alternatives. And I guess the one thing for your exchange members would be, am I set up for the alternative, and will I be able to get margin offsetting so that I can manage my risk efficiently? Because as we know, when prices go up, as Ries just said, that's when you have a margin and collateral issue. It's not when things are fine. So Stefan, if you could talk us through that would be great.
Yeah, happy to. Look, I mean, to begin with, I think we are not really convinced that a price cap is an effective tool to mitigate the situation that we have. Simply because, I mean, if we look at what have been the driving forces in order to weather that storm that we've seen last year in the 2022 energy crisis, I think it has been three elements. Number one, it has been a good portion of luck, because it was a mild winter and it was a mild autumn. Two, it was policy response, building up LNG terminals across Europe. And number three, it has been market forces. High prices have given a clear signal to cut down demand on a private level and on an industry level. Now, with the price cap being implemented and being effectively there, for us as an exchange operator, it's important to give market participants choice and to safeguard the markets even in uncertain times. So therefore, we were looking at what can we do in order to provide market participants with the right tools to trade in a cleared space, although the market's price cap is effective. So what we've done is, as you said, I mean, we've launched an OTF, an organized trading facility, with products that are pretty much lookalike products. So it's the same products, not listed on the regulated market, but on the OTF. And interesting enough, the regulation coming from the European Commission with regards to the market price cap said, well, we only limit the prices traded on a regulated market. You can trade on the OTC market, you can trade on an OTF. There you can trade at whatever price. And obviously for our market participants, they have to prepare for the situation. I mean, that's exactly the point that you're referring to in the poll. If it gets close to the limit, what can they do? And I think we are living in a global energy space. We're not living in a European energy space here, right? So we have to ensure security of supply. And we have to attract LNG cargoes at higher prices than the market price cap. And so market participants will find ways to trade outside regulated markets. And for us, providing an OTF and provide a cleared OTF is one way to provide security and stabilize markets in that sense. Because otherwise, we will not attract LNG cargoes that are necessary to keep the lights on and to keep the house warm for next winter, maybe the winter thereafter. Yeah, I mean, we are living in a global context here. And last year, Europe has emerged as one of the biggest importers of LNG in the world. Yeah, and I think it's difficult to believe that you can cap a price locally, although the market price formation is on a global level. Yeah, so therefore, we think having an OTF and a cleared OTF and providing choice to market participants is a good idea and actually welcomed by the industry.
Okay. And one thing, that's all very interesting, and one thing that's a point worth making that Acer and ESMA, in their impact assessments around that, kind of rejected, well, not rejected, but said it would be challenging to extend to other VTPs or other venues and things like that. So it seems like the price cap as currently constituted, you know, we can't have certainty. It seems like that's essentially the way it's going to stay. But a solid number 2 in the poll was flows to OTC, which is actually quite surprising and interesting to me. And there's a third point in the poll, but we'll stick on that. Rees, you said you had, you definitely had an experience of some of that happening last year. Is there, do you have an idea of kind of the attractiveness or not of the OTC markets as things get volatile, or was that a very much a sort of one-off effect?
No, I think it will remain, because people have gone scared on liquidity risk.
Yeah.
I mean, the liquidity risk was so severe that people got so scared that they are now shorter hedging and going OTC just to mitigate that and taking outright or a counterparty risk, so just changing that. And obviously, I mean, we all remember the banking crisis. It started with taking counterparty risk because it was not margined and not viewed. So in my view, the biggest risk is how do you monitor that? How do you monitor exposures on each other? I mean, looking at Uniper, who would have thought that they have 40 billion losses with being exposed in the OTC market? I mean, if those kind of things are in the system, then I think there is a big risk. It's not transparent and not safe and transparent, but obviously we want everyone to go to the exchange. So I think we need to look on how to make the exchange more attractive again for our clients.
Yeah, and that touches on a lot of the points Peter made about the kind of Polish experience. But I suppose the most interesting and surprising thing to me is I think we had 12% onshore, which was the real kind of danger signal you were saying, is that uncertainty is the thing that really kills things. If you know what's happening, you can take action, but if you don't know, so at least reading the room, I mean, that's a surprisingly high number for me, because it's certainly a topic that people get very excited about. So I would have expected a view either way on that.
To me, it's quite concerning to see that people believe, I mean, about 1/3 believes that flow to OTC will increase, because I think that's not something that we should hope for, to be honest. I mean, as you said, right, because you're basically swapping liquidity risk with counterparty risk. Now, look at the liquidity risk. I mean, what we've seen last year is that even the biggest of the biggest had issues financing margins, and you mentioned it, yeah, but people had a mark-to-market risk. I mean, they did not something wrong. I mean, there have been utility firms who entered into a hedge position 2-3 years ago at price levels, and I mentioned it, like 40-50 euro, and then prices spiked to 1,000. Yeah, that triggers all sorts of margin calls, and but they did not something fundamentally wrong. They did an economically rational decision to hedge. So therefore, I think the policy intervention that we've seen last year, that governments provided liquidity in order to cover margin calls, I think that was a really, really good decision. And I think we should try our best not to see volumes flowing back to OTC and opaque markets again, not only from a counterparty risk, but also from a market access point of view, because the biggest of the biggest, they may have credit lines in place to trade with each other, but the energy market is diverse, and we have mid-sized players, small-sized players, and new joiners from the renewable industry space, for example. And we need to ensure that they have equal access to markets, and typically that's the exchanges and not the OTC markets.
Yeah, and it's a diverse market. It serves a critical function, and it matters to people in their pockets. And taking the theme, and we've got to this point, you could read the title of this panel two ways, right? So we've talked more about sustainable markets in power. Now I think we should move to sustainability in markets, right? So Michael Peters has said, green and ESG is critical for everyone. We should all focus on it. It's it's probably one of the most direct consequences in energy in the cost and also in the infrastructure and how it works. So I think we should talk about, how sustainability in the markets, what's going on the product side, what's going on the client side in terms of differentiation, restrictions on investment. So if we start with you, Resh, maybe,
Yeah, so my view, obviously, if you look in the next decade, and electrification is gonna happen, right? The car industry, the automotive industry, heating with power. So the demand for power will increase drastically in this whole energy transition, which is what we need to produce. We need to produce more power, and that preferably with renewable sources. So that's something which is going to happen, but it gets a lot of challenges. And one of the challenges which people tend to forget is also the infrastructure which is required for that. So the base metals which are required to facilitate this energy transition, so the copper, the nickel, the aluminium needed to make the whole infrastructure, that's also going to be a challenge, because there's they did not make that many investments in mining. Some of the banks are also afraid to finance the mining industry because of ESG components, but we need all of these materials to facilitate that energy transition. So it's going to create volatility, in my view, on the metals market because of the demand and the disbalance or the imbalance in the supply and demand. So that's one thing. And the other thing is obviously on the power trading is that the energy mix for producing power will change. I mean, you use, of course, have coal, nuclear, hydro, renewables, and gas. And obviously, we're going to phase out coal. We're going to look at nuclear. I mean, some are getting out, some are getting in. I mean, that's still debatable. And then you have, of course, hydro. And those are more the base load. So that will create a base load and a base production of electricity. Because as you all know, electricity, you can't really store. I mean, you have batteries, but economically to store that is going to be hard. It's going to be a challenge. I mean, what we see now, this light, the electricity for that has been produced 15 minutes ago. So that makes it a dynamic environment. And if you then look at the shifting towards more the renewable side, where it's solar or wind, if there's no wind or no solar, yeah, you need to keep on balancing the grid, otherwise the lights go out. And if you produce too much, the lights might jump off because you need to balance it. So that will be I think the challenge, and also will create a lot of volatility, that the base load will become less, and we'll be more dependent on more volatile ways of producing power, while the demand for power will also increase. So that's the challenge, which is why I think we need safe and ordinary markets to make sure that the clients are able to trade on them.
Yeah, it's critically important. And in a way, what we were talking about, well, everything we've been talking about so far from last year is a supply shock, essentially, right?
Yes.
And the effects of a supply shock. And you're saying, you know what, if we're all kind of have a leveraged risk to the climate for our electricity generation, for these aggressive targets that governments around the world are trying to institute,
Yeah.
we need to prepare for that volatility, which is another kind of theme of the conference. Peter, has the from the Polish experience, is sustainability and these targets and renewables kind of front of agenda? Has it started to move the needle? Is it something that drives the agenda, or is that something that is sort of yet to come?
Of course, I totally agree with what Guy said. Especially in Poland, we have 80% production basing on the coal. So we need to change. We need to change that. That's why the government is looking for some partners for building the nuclear power in Poland, for having the base, for adding to this base renewables like wind, solar, hydro, just to take away the coal from the production mix. It's very important. So there are a lot of investigation will be in and are in Poland. However, somehow calm because of the situation, because of the prices of the steel and everything. It's a little bit, and the price of the energy that was capped. It's also the problem in Poland for making investments. From my perspective, from the perspective of exchange, we need to provide for those investments products with long-term hedging. It's very important for our clients to have such possibilities. To show to the investors, to the banks, that their investment is hedged with the price, with the earnings, etc. So it's one thing. And what you said also about volatility from the renewables. We have one day with sunny day, one day windy. We might have negative prices on the energy. That's something common in German market. So that will have impact on the spot market, especially day by day. It will be very interesting also for non-professional, let's say, customers. Not professional, I mean the trading company from the electricity side, because trading in Poland, you need to have the licenses to trade on the gas and electricity with physical delivery. But when we implement the financial products, that will be even physical. The physical person could be the person that could trade on the exchange. That will be something. They might produce their own energy, but they would also hedge the price for the future, and also just having a game on the exchange a little bit. So.
Yeah, which is always a danger with
Interesting
markets,
future.
right? It's a danger. So Stefan, you're also sitting from the exchange side. There's obviously market-based tools, stuff you can do to support project-based finance, for example, or obviously carbon trading, things like that, or offsets. What have you been doing to try and support that, and what do you think kind of needs to be done more to try and help support that kind of shift to sustainability, or support markets with the kind of certainty that they would need as we go through this process?
Yeah, I think we had 2 panels yesterday on carbon, so excuse me if I leave carbon out for a moment.
Perfectly
and focus
happy.
on the energy markets.
It was merely an example, building markets with global prices with factors embedded there.
Exactly. So when we look at power markets, and I mean, Gijs, you mentioned it nicely, I mean, there needs to be a lot of investments, hundreds of billions on investments in order to reach the targets that the European Union has set itself when it comes to renewable energy generation. I mean, we have a 40% target by 2030 at the moment, where 45% being discussed as part of the Green Deal. So there needs to be more renewable assets being brought to the market. Now, for us as an exchange, that means, I mean, we need to provide tools in order to allow renewable investors to hedge their exposure on an exchange. And before, I mean, like 5-6 years ago, the typical hedging horizon of a utility would have been like 2 or 3 years. Oh. Yeah. But now, when you build a wind park, when you build a solar park, I mean, you want to hedge your exposure for 10, 15 years in advance, because fixed feed-in tariffs, I mean, these times are gone. I mean, fixed feed-in tariffs in many European countries do not exist anymore, and in other markets they are scaled back quite significantly. Yeah? So they have to recoup their investments with market-based tools. And for that, I mean, we as EEX, we're working closely with the industry in order to provide tools that allow really PPA hedging. Yeah? So we've extended our curves up to 10 years. Yeah? So you can trade now up until 2033 on the market. Yeah? That's one element. And then the second element is we have more and more investors also from the financial community that want exposure to energy markets, but they don't want exposure to fossil fuels. Now, if you look to the leading benchmarks of the world, like GSCI, right? I mean, if you look into the composition of the GSCI World Index, I mean, there's a lot of fossil fuel in there. Yeah, there's very little electricity in there. So last year we've worked together with GSCI in order to build indices that reflect the development of the German power market, for example. And the German market last year has reached a record level of renewable generation. Yeah? So last year, 46% of electricity consumed in Germany was coming from renewables. And that will be 80% according to policy targets by 2030. Yeah? So there will be also products around, ETFs, other products linked to these indices that track the performance of the German market as it transitions from a fossil-driven market to a renewable-driven market. And I think that's an important message for the industry.
Okay, so as Rees said, while there's an issue with a kind of fixed flow, if you like, or at least certainty of flow, it needs to be supported by products that kind of help that renewable percentage or ratio go up.
Yeah, absolutely. I mean, and that also comes again to the point Gijs made about margins. Yeah, I mean, if we look at a 10-year contract, for example, yeah, that means you have to pledge collateral for 10 yearly contracts. So that's millions of euro of collateral that is required. Yeah, and there will be banks that will be in the market in order to finance these collateral. But I mean, we've seen last year that the utilities got government support in order to finance their margin requirements on the exchange. Maybe it's a good idea also for policymakers to look into margin financing for renewables investors.
Yeah, and nudging up that kind of level, I think I saw some statistics about the number of projects that actually come to fruition or whatever, and it's shockingly low. So they obviously need some kind of help there, and if you can support the utility companies at a time when they definitely did need it, there's no reason why, if you're trying to meet these aggressive targets, you might not do that. But sounds like we're all very keen on government intervention somehow from the beginning of the thing. Okay, from the clearing side, particularly, just thinking of products and how you position yourselves, is there any sustainability-led changes that you're having to make, disclosures, things with clients, metrics for members, things like that?
Yeah, more and more we measure our clients on sustainability parameters. So we onboard clients which meet our minimum requirements. So we do that on our onboarding. But I think, to be quite frank, our role in this whole energy transition is to make sure that this market operates and it's safe and transparent. And we will support and facilitate markets which are part of this energy transition. So if there's, for example, going to be a hydrogen market, we'll definitely look at that and see if we can provide liquidity and provide our client base access to those exchanges. I think that's our role as a clearer, to make sure that those markets keep on functioning and that we grant different participants access to those markets. Because obviously we also have a relatively big pool of liquidity providers. So providing our liquidity providers also access to these exchanges will hopefully also get additional liquidity in those exchanges, making them more liquid and more transparent. So that's our role as a clearer, to make sure that we are there. And we've been in the power markets for over 20 years, so we have a long track record in that sense on building this up. And yeah, we still believe we really have a function there.
So maintaining liquidity through volatility is the best way you can.
Yeah, but I do think we need to look at some things. I mean, there's two things which changed now, right? Last year the interest was low.
Yeah.
So can you imagine having 100 billion of margin posted at exchanges, which at that moment in time was close to zero, the cost. Now it's 5% on interest. So there's going to be 5 billion of cost already to facilitate or to finance that. So also these kind of parameters have really changed. So that's different.
Okay, fascinating. If you have any questions, now is the time. Ping them through on the app. So that's a very wide-ranging discussion we've had. If I can bring us back to the start. Kind of persistent volatility has been the theme, but if you think forward for a year, what is going to be the thing that we're talking about when we're sitting here? Is it going to be volatility again? Are we going to be talking about the sustainability-led initiatives? Or are we going to be talking about kind of flows to different markets? OTC, other venues, whatever.
Well, I think, I mean, we've seen that markets have really worked as they were designed for last year. And so today we are in a complete different situation. And today, I mean, we are looking at the market that is almost where it was before the crisis. Yeah. So I would say that the sustainability element will come way more into focus again. Last year it was all about security of supply and stabilizing markets and safeguarding markets. This year will be really about sustainability again. And we will see volatility for sure. I mean, no one knows how events will unfold in the Ukraine and what may or may not happen in the energy markets going into the next winter. Yeah, but I'm very much optimistic that really, I mean, sustainability and that transition from fossil to renewable will be the core topic that we will discuss next year, as we've weathered the storm so far very well. Yeah.
So coming back to the front and the agenda widening out. Peter, maybe from your perspective.
I agree. Sustainability, supplying of gas. We are almost, the winter is over, but
That's a topic
the next
in
winter,
itself. We could have spent the whole
next
time.
winter is ahead.
Yeah.
So we need to take gas from somewhere. Lots of gas was imported by Nord Stream before. Now there is no Nord Stream. So there will be a pretty challenges for importing gas. So sustainability will be one thing. We have new market design currently that is in discussion in European Union. There are some new propositions of energy market design. So we'll see what will be the product from that. So we don't know exactly what will be the things.
Yeah, and that's actually one of the key concerns, to be honest, that policymakers are trying to fix an issue that does not exist anymore.
Mm-hmm.
And the outcome may actually make the situation way worse. So therefore, we have to be really careful with all these interventions, because the interventions are targeted for a situation that we have seen last year in August. Mm-hmm. Yeah? And I can just reiterate, I mean, markets have worked as designed, and we are now at the situation where markets are where they were before the crisis. Yeah? So we should not try to fix a very, very short-term challenge that we've seen in August and distort the market going forward.
Yeah. And of course, what we haven't mentioned is there's a lot of other long-term projects coming down the pipe. People talk about hydrogen quite a lot. And obviously that's going to be, if it comes out, will be a kind of competitor on the storage, on that storage dynamic. But Gees,
I don't think we need to learn from what happened last year, because one of the things is the severity of the speed of the liquidity need. I think if we can dampen that effect by any way, I think we're also active in the LME market, and we've seen what the nickel has done, rising 250% in 24 hours. It kind of almost created a snowball effect. I think we need to also be very wary, okay, that we need good market infrastructure and also good market intelligence to manage that we do not get these kind of things that far out of control. I think that's a very important lessons learned from at least also the LME side, but also what we've seen in the power and gas market. Make sure that people are able to provide and come up with the liquidity, because if it goes too fast, then these kind of things happen. So I think we need to be also wary for that.
I think transparency is a key point there, right? So it's resilience and efficient oversight of markets. So I think when you guys mentioned more volatility in metal markets, I have to say my heart sank, and I said, how is that even possible? But yeah, that's probably a good or slightly pessimistic, but good point to end on. Thank you very much for your time. Hopefully everyone enjoyed it. Thank you. Join me.
Yeah.